Generally accepted accounting principles, or GAAP for short, are the set of guidelines and procedures that constitute acceptable accounting practice at a given time, or the broad general statements that serve as guides in the practice of accounting. Meaning to say, in a similar way, a compass, Google Maps, and the Waze app direct travelers to reach their proper destination. Generally accepted accounting principles guide accountants and even accounting students in doing their accounting tasks correctly. That being said, you must have realized how important this topic is, because you must follow these principles, rules, standards, and practices in the recording of transactions up to the preparation and presentation of financial statements. Generally accepted accounting principles may be divided into two: the accounting principles and the accounting assumptions. First in line in our list of accounting principles is the revenue recognition principle. This tells us when to recognize or record revenue or income, because the common understanding of many people who do not have any accounting background is like this: when you receive cash, you have revenue or income. When you haven't received cash, you do not have revenue. That is wrong. According to the revenue recognition principle, revenue or income must be recognized or recorded when it is already earned. The question is, when is it considered earned? When service has already been rendered or performed, or goods have been sold, regardless of whether cash has been received or not. Let's say you own a beauty parlor. A neighbor entered your parlor and asked you for a hair styling service. You obliged, but after styling her hair, she told you, "Oh, I forgot my wallet. May I just pay you next week when I pass by here again? Anyway, you know me, I just live nearby." Question: do you have revenue or income? The answer is yes. Even though she has not paid you yet? Yes, you already have revenue because you already rendered or performed the service. That is in accordance with this revenue recognition principle. Revenue is recognized when service has been rendered or goods have been sold. Of course, in that example, since the customer has not paid you yet for the service, you do not have cash received from her. But my question was not, do you have cash? But, do you have revenue or income after styling her hair? Remember, cash is an asset, not a revenue or an income. You have not received cash from her yet, but you already have revenue because you have already rendered or performed the hair styling service. A principle very much related to the revenue recognition principle is the expense recognition principle, which informs us when we must recognize or record an expense. Because the common understanding of many who have no accounting background is like this: when you have paid cash, you have expense. When you have not yet paid cash, you do not have expense. That is wrong. The expense recognition principle dictates that expense must be recognized when incurred. That is, when goods and services have been used up, regardless of whether cash has been paid or not. Because in the same way that revenue or income does not mean cash, expense does not mean cash either. Let's have a very simple example. Assume that you went to a nearby barber shop to have your haircut. After having a haircut, you realized you forgot to bring any money with you. So you said to the barber, "I left my wallet at home. but don't worry, I will pay you tomorrow. Take note, you haven't paid cash. But after having your haircut, do you have expense? Yes. Why? Because you already received or used up the service. That is according to the expense recognition principle. Another example, let's say you received an electricity bill from Meralco. What does it mean when you receive the bill? It means that you are being asked to pay. For what? For the supply of electricity provided to you during the past month, or for the electricity service is still to be rendered to you in the future. For the supply of electricity provided to you during the past month. In other words, you are being required to pay for the electricity service you have already received or used up in the past. So in that case, upon receipt of the electricity bill, when you haven't paid Meralco yet, you must already recognize or record expense. Regardless of whether or not you already paid cash, as long as you have already received service or used up an asset, you already have expense. By the way, in many textbooks, there is a continuation to this description of the expense recognition principle. Expense is recognized when goods and services have been used up to produce revenue. From this, it is quite easy to see why the expense recognition principle is also known as matching principle. Because the expense is matched against the related revenue, or the effort exerted by the organization represented by expense is matched against the result or outcome of that effort, which is represented by revenue or income. Note also that the two principles I just discussed, the revenue recognition principle and the expense recognition principle, are known as accrual principles. Accrual accounting shows the effects of transactions, events, and other circumstances on an entity's economic resources and claims in the periods in which those effects occur, even if the resulting cash receipts and payments occur in a different period. Next accounting principle, exchange price or cost principle, which requires that assets, liabilities, income, and expenses must be recorded based on the price established at the time the exchange took place. For example, you purchased a laptop with a list price of 80,000 pesos, but the seller granted you a trade discount of 2,000 pesos. At what amount or cost must you record the laptop? At 78,000 pesos, because that is the price you agreed to buy the laptop for at the time of the purchase. 78,000 is the price established at the time the exchange took place. Let's say after a month, you purchased a similar laptop, same brand, same model, same specifications, which you intend to give to someone. At the time of that purchase, however, the price is just 70,000 pesos. At what amount must you record the second laptop? At 70,000 pesos, because that is the amount you and the seller agreed upon on the date of your second purchase. You must not say, I will record it at 78,000 pesos also, because anyway, I had purchased the first one at 78,000 pesos and the two are of the same brand, model, and specifications. You must not say that. Another accounting principle is consistency. From the word consistent, Maybe you know someone who has been a consistent honor student or a consistent awardee in a certain sport. What does that mean? What is meant by the word consistent? It means acting or done in the same way over time. Based on that, according to the consistency principle, a business entity should use the same accounting methods from period to period in order to achieve comparability over time within a single enterprise. For example, in determining the cost of merchandise inventory or the products intended for sale by the business to be presented in the statement of financial position, a company may use either the FIFO method or the weighted average method. I am not going to explain to you what FIFO or weighted average method means. That is for a higher accounting subject. For now, suffice it for you to know that an entity may choose between FIFO and weighted average in costing merchandise inventory. If the company used the FIFO method last year, according to the consistency principle, it is better to use FIFO again this year and in the succeeding years in order to better compare the cost of ending inventory from year to year. It does not mean, however, that changes in accounting methods are not allowed. Changes are permitted if justifiable and disclosed in the financial statements. As long as there is a valid reason for a change in method and it is stated in the financial statements, specifically in the notes to the financial statements, the change is allowed. Next is objectivity, from the word objective, meaning impartial, neutral, free from bias, not influenced by personal feelings. Therefore, according to the objectivity principle, accounting information entered in the records must be verifiable and supported by proper documents such as official receipts and sales invoices. Let's say the cash in bank balance in your statement of financial position, one of the 5 financial statements, amounts to 420,000 pesos. You must be able to prove that that is the correct balance. When another accountant makes an audit or an examination of the financial statements you prepared, he must be able to confirm or validate that figure. Meaning, he must be able to arrive at the same amount, or at least at an amount very close to the 420,000 pesos balance of the cash in bank. In case there is really no available document to support a certain information, that is when an accountant needs to just use his judgment and make an estimate, such as estimating the useful life of a fixed asset or the amount or percentage of accounts receivable which may not be collected. There should be an objective factor used as a basis, like the past experience of the company or other companies in the same industry. Full disclosure. Full, meaning complete, not lacking or omitting anything. Disclosure, from the word disclose, meaning to reveal or make known. Don't hide anything. Don't keep it a secret. So according to the full disclosure principle, all relevant information that would affect the stakeholders' understanding and assessment of the accounting entity must be disclosed in the financial statements. For instance, the company has land costing 15 million pesos with a building valued at 10 million pesos. Those properties have been mortgaged or used as collateral or security to obtain a loan of 12 billion pesos. Meaning to say, Should the entity fail in its obligation to repay the loan, the creditor will take ownership of the land and building, of course after undergoing foreclosure proceedings. Because under the Civil Code of the Philippines, a creditor cannot simply appropriate the things given by way of pledge or mortgage or dispose of them. Even if the accountant of the company reports the correct valuation of the properties in the financial statements, he is still in violation of this full disclosure principle if he fails to disclose or reveal the fact that those assets have been used as collateral to secure a loan, because the mortgage information is a relevant or significant one, which may influence the decision of users of accounting information. Some authors of accounting textbooks include the concepts of materiality and conservatism or prudence as part of their discussion on accounting principles, but I am going to discuss those in another part of this lecture series. Let's proceed now to the accounting assumptions, which are the basic notions or beliefs on which the accounting process is based. When we say assumption or even belief, are we certain that what we assume or believe is really true or is a reality or a fact? Of course not. Assumption or belief is just acceptance of something to be true, but there is no certainty about its truthfulness. As a matter of fact, as we discuss these so-called accounting assumptions one by one, you may just realize that some of them are obviously not true. But just the same, as accounting students, you must accept them to be true because, as stated here, they serve as the foundation of accounting in order to avoid misunderstanding, but rather enhance the understanding and usefulness of the financial statements. Business entity or accounting entity or even economic entity or simply entity concept. This assumption states that the business enterprise is separate and distinct from its owner. The owner is considered as one person, the business is considered as though it is another person, such that in preparing the financial statements of the business enterprise, only the assets, liabilities, revenues, and expenses of that entity should be included. Personal assets, liabilities, revenues, and expenses of the owner should be excluded. Let's say you have 7 million pesos. I say you, meaning the 7 million pesos belong to you personally. Let's assume further, you invested 5 million pesos out of the 7 million pesos in your business. The moment you do that, according to the business entity or accounting entity concept, that money amounting to 5 million pesos no longer belongs to you. It already belongs to someone else, to another entity, which is your business. Come to think of it, in truth or in reality, is that money amounting to 5 million pesos still yours? Of course, it is still yours. Why? Because you own the business. Whatever asset your business acquires belongs to you because you own the business. However, according to this entity assumption, you must not think that way, especially when recording transactions and preparing financial statements. You have to think that you and your business are separate and distinct from each other. Another example, you purchased a house and lot for you and your family's dwelling using your own money. That purchase transaction is a personal transaction which must not be recorded in the books of your business. Another accounting assumption is going concern. Based on this premise, the business enterprise is a continuing concern or that it has indefinite existence. Simply stated, from the word going, an accountant has to assume that the business will continue to go on and on and on and on. And therefore, financial statements should be prepared on a going concern basis unless the owner intends to liquidate the business or to cease operation. It also follows that properties are assumed to be used for a long period of time and therefore should be recognized at their original purchase cost without regard to changes in market values or current values. Having said that, it should be clear that the exchange price or cost principle discussed a few minutes ago is based on this going concern assumption. In addition, this assumption permits an entity to defer or postpone the recording of some of its expenses and income, as well as to accrue income and expenses. More on these deferrals and accruals in the topic of adjusting entries. Time period, accounting period, or periodicity is another accounting assumption. In much the same way as your life as a student is divided into several periods such as elementary, high school, and college, and each period is further subdivided into academic years such as first year, second year, third year, and fourth year in college, and each academic year in college is even further subdivided into semesters or trimesters, at the end of which a grading report is prepared so you know how well you performed during a particular term. The life of the business must be subdivided into equal time periods for financial reporting purposes. Meaning, financial statements must be prepared periodically or at regularly occurring time intervals. And speaking about periodic preparation of financial statements, please remember that the basic accounting period is 1 year. Meaning, an economic entity is required to prepare financial statements at the very least every year, annually. It may prepare financial statements more often than yearly, such as monthly, quarterly, or semi-annually, but it must not do so only every 15 months or every 2 years. At least once a year, financial statements must be prepared. Also considered an accounting assumption is the monetary unit concept, which has two aspects, the quantifiability aspect and the stability of the peso assumption. The quantifiability aspect mandates that all business transactions should be measured and recorded using only one unit of measurement, which is peso in the Philippines. Even if, let's say, your business purchased a certain asset by paying US dollars, when recording that transaction, the amount in US dollars must be converted to Philippine pesos because your business operates here in the Philippines. The quantifiability aspect also requires that only data measurable in terms of money must be recognized and recorded in the books of the entity. Because remember, the phrases we encountered in the definitions of accounting, financial in nature, in terms of money. The other aspect of the monetary unit is the stability of the peso assumption, which states that the purchasing power of the peso is stable or constant, and that its instability, if any, is insignificant and therefore may be ignored. Again, this is just an assumption. You probably know that in reality, the purchasing power of the peso normally decreases as time goes by because of inflation or the increase in the prices of commodities. Meaning, your, let's say, 10,000 pesos 5 years from now will be able to buy you less amount of goods and services than your 10,000 pesos today, because the prices of most products would most likely be higher in the future than they are now. That's why the purchasing power of the peso normally decreases as time passes by. That is the reality. Purchasing power of the peso normally decreases. But in accounting, we need to accept this stability of the peso assumption, which tells us that the purchasing power of the peso is stable or constant, and that its instability is insignificant and therefore may be ignored, because the accounting function is to account for pesos only and not for changes in purchasing power caused by inflation. That's it for part 1 of this lecture series. Thank you for watching.